But let's talk about the economy. How are you thinking about the possibility of a recession and a potential pullback in ride-hailing demand, maybe even delivery demand, as people's budgets get constrained?
Yeah, it's a little sad that discussions on the economy are unwelcome now, especially at the Bloomberg event. So I think there's lots of speculation as to whether or not we go into a recession or not. I'm not an economist, so I won't speculate.
Other CEOs are not having that problem.
Yeah, exactly. But we get a pretty live pulse of what's happening on the streets every day, right? And in the cities in which we live. And at this point, we don't see any signal of a recession coming. Now, what's different about us than most companies out there is that, just as you saw during the pandemic, a shift from spend on services to spend on retail, that shift is now going back to services, and we are the definition of a service, right? Moving around, travel is back, et cetera. So I do think that our service is benefiting from the shift back. Certainly the reopening helps our mobility business. Our mobility business is growing at very, very high rates, highly profitable. The delivery business, delivery of everything at home, continues to be strong. So at this point, we don't see any signal whatsoever. We have gone through recessions in South America, Mexico, and Brazil in the past. And what you see during those recessions is that as a labor pool eases up, and certainly we don't see signs of that yet here or in Europe, more drivers come onto the platform. And as more drivers come onto the platform continues to grow, service levels get better. So I think versus many other companies, we don't have large asset base. Our cost base essentially adjusts. In stronger economy, our cost base increases as earners and drivers earn much more money. In weaker economies, as you get more drivers into the marketplace, their earnings adjust as well. So I think we are relatively recession resistant if it happens. I certainly hope it doesn't happen. Right now, the signal on the street is things are really strong, and the spend on services continues to be quite robust.
Okay, but you mentioned drivers. Now, driver economics right now are under assault. I mean, as we all know from filling up our gas tanks, unless you have a Tesla, or from those social media photos of $10 gallon gas,
yeah,
that's hitting drivers. Now, you have a fee to help drivers, a gas surcharge, but you're sunsetting that on the delivery side. So what else can you do to help drivers who are now finding the economics of driving for Uber aren't what they once were?
I think the good news as it relates to drivers is that if you think about a driver as essentially a small business owner, the revenue side of the business looks really good, right? And while inflation is pressuring every business, as it relates to driving now, drivers we talked about last quarter, drivers who drive, call it 20 or more hours on the platform, are earning in the US $39, over $39 per utilized hour. So the revenue side of the equation is looking quite healthy. And while
the costs are
up, yeah, the costs are up, and no one's happy about gas prices right now. When you look at the driver P&L, the driver P&L, so to speak, actually looks pretty healthy. And we're seeing more drivers come onto the platform as a result. I'm certainly hoping for lower gas prices. Everyone is. But it's not affecting our business.
Have you thought about preserving that fuel surcharge on the delivery side or extending it further on the drive side?
Well, certainly on the mobility side, at this point, we intend to extend it. On the delivery side, a significant amount of our deliveries come from bikes, scooters, et cetera, that isn't as directly affected by those kinds of economics.